Okay, let's start. We have few people here. So last week, we discussed several things. We discussed losses. We have expected loss. Then we have unexpected loss. Then we have exceptional loss. Right? But we told, since this is exceptional thing, we don't consider as a risk. Right? Then expected loss is handled through provisioning. Right? Then the remaining unexpected loss is handled through capital. Right? So we discussed these things. Capital, then we came into capital. What is capital? Capital, we have three types: tier 1 O capital, tier 2 O tier 2 capital, and tier 3 capital. Tier 1 capital, example, share capital, P&L reserve, like that. Can you see the board? Can you read the board?
No, sir, we can't read.
Okay. This color you can read?
Yes, sir.
Okay. Right? What I was explaining was last week we discussed losses, different types of losses. We have expected loss, unexpected loss, and exceptional loss, right? Since this is an exceptional item which we can't predict, or we don't know what will be the effect, we don't consider this as a risk, right? Then we came into expected loss. We tackle expected loss through provisioning. As we project our revenue in PL, we project the provisioning as well. So this is tackled under provisioning. So this is also not a risk, right? Then we came into unexpected loss, right? Which will occur over and above expected. So for this kind of a loss, we need to have our capital. Capital means the owner's funds. Then we came into what types of capital? We have tier 1 capital or co-capital, then tier 2 capital and tier 3 capital. Tier 1 capital, share, ordinary shares, share capital, then P&L reserves, tier 2 capital, debentures, then general provisioning, and those things. Then tier 3 capital is subordinated, short-term debt with 2-year maturity, right? 2-year maturity. So these are capital. So as I told you, banks are funded like this: TMD, term deposits; CASA, term loans obtained; money market short-term borrowings; and capital. Right? We need capital to tackle any unexpected loss, because if we get a loss, we can't go back to our depositors or the lenders and tell them that we gave a loan, now they are not repaying, so I'm not in a position to pay you back. But we can go to our shareholders and say, we made a mistake, now we can't pay you. No dividends or write off capital or whatever, it is their own funds. We can go to this. So this is the capital. So then we went on to discuss Basel. Right? Basel is the one who, Basel is a city where BIS, Bank for International Settlements, located at. Right? After the 1974 bank collapse in Germany, all the heads of central banks came together to decide on a level playing field for internationally active banks. So they decided, whenever you are playing internationally or a bank, you need to have your own capital. If you are small, do small businesses and gradually grow. If you are big, you can do the big businesses. So you can't do big businesses if you are small, right? So they developed something called minimum capital adequacy, right? Minimum capital adequacy ratio, which is equal to capital divided by risk weighted asset, right? For the time being, just hold this one, risk weighted asset, right? So that means, so initially it was 8%, right? Very layman terms, if you want to give 100 rupees, you won't need to have 8 rupees from your own capital, and the balance can be funded from these borrowings. 92 rupees can be borrowed through that, right? So that is the meaning of this. What have they done? They have caught us from our tail. If you need to allocate your capital whenever you are giving a loan, whenever you are taking a facility, giving a facility, you need to have your own funds. If you don't have enough funds, you can't do big business, right? You just can't borrow and lend, or for any facility you grant, you need to have your own funding, right? So they blocked us doing larger business without having proper means. Risk weighted. Under Basel I, they told the biggest risk a bank will run into is credit risk, right? That is the biggest risk, credit risk. What is credit risk? That is, very layman term, will I get my money back, right? When the customer is more than 90 days in arrears, or when the bank thinks that the customer will not pay in full, then it is credit risk, right? It's the uncertainty that the counterparty will honor the commitment as per the agreed terms, right? That is credit risk. So they told credit risk is the key risk in this banking, right? Then they gave us some risk weights: 0, 20, 50, and 100%, right? If you are lending against cash, gold, OECD governments, US Treasury, you don't need to have your own funds. You can borrow everything and say, because it is 0 here, this part is 0, so you don't need your own funds, right? Then they went on to say 20%. If you are lending against banks in OECD, local governments, like that, you need to have 20%. So that means 20% into, if it is 100, which is 5, right? 5 divided by, this is 100. So you need to have 5 rupees for each 100 rupees. Then they went on to say, if it is residential mortgages, it is 50%. So that means you need 4 rupees of your own funds and balance you can borrow. Anything else, it is 100%. It can be a micro enterprise or corporate, big corporate. Still, it is the same, right? So that is the mistake we had in Basel I. So Basel I is the one who introduced the risk weights to capital calculation, right? So it is very easy. 4 categories. Everyone was here, whether it is me or Haley's group, the risk weight is same. So because of that, we had an issue. Some banks were paying differently. Like some banks were taking risk, giving all the high risk categories using the same capital, but some banks were conservative and giving only the good facilities. So there was no proper judgment on the risk taking. So this is called regulatory capital arbitrage. That means with the same capital, 2 banks can play differently. You will not know the risk, different risk, because higher the risk, higher the return, lower the risk, lower the return, right? That is risk-return trade-off. Okay. So we had 2 issues. First one, they considered only credit risk, one type of risk. Second one, Basel I paid the way for capital, regulatory capital arbitrage. They didn't bother about any market risk. There was an amendment. They considered one credit and operation, credit and market, but not the operation risk, right? So this is based on the Basel I. That's the place I stopped my lecture last week. Today we will start Basel II. I think Right. This is the place I just touched upon. The difference between Basel 1 and Basel 2. Right? Basel 1 was focusing mainly on the single risk, which is the credit risk. Then one size fits for all, scope for regulatory capital arbitrage. Then operation risk was not considered. Initially, Basel 1 started with credit risk. Then subsequently, they started considering market risk as well. However, they didn't bother about the operation risk. This is Basel 1. Comparing to Basel 1 and 2, Basel 2 will be concentrating more on banks' internal risk management methodologies and supervisory and market discipline. It is a three-pillar approach. We have internal risk control, supervisory, and market. Right? I'll explain you just after this. Then flexible menu. Earlier, we had only very strict 4 items. But here, under Basel 2, they gave few methods to use. If you are good in your risk management, you can bring down the capital requirement. Then the collateral was considered. Then third one, they introduced the operation risk as well. Right? So Basel 2 is considered as 3-pillar mechanism. Right? So first pillar is for my side is the leftmost one, minimum capital requirement for credit risk, market risk, and operation risk. We will be discussing on credit risk. Then supervisory review process. Right? I'll tell you what that is. Then the market discipline. I'll tell you what that is. Right? This is the 3 pillars. Minimum capital requirement, pillar 1 is the minimum capital requirement for credit, market, and operation. Then supervisory review, we need to develop a mechanism to tackle all other risks which are not covered under pillar 1. And the supervisor is our central bank. So they need to evaluate our calculations. Right? Then third pillar, that is the market. I'll start from there. Market pillar is like, currently we disclose everything in our annual reports. From the remuneration to the chairman and the board of directors to the CEO to the top management. Then all payments, risk appetites, CSR projects, all the balance sheet items, everything has to be very transparent. And why? Basel told you have to declare everything. Then the market will go through that. If you are good, they will invest on you. If you are bad, they will not invest. So your share prices will fluctuate based on your disclosures and your management. So market will have a hold on your operations, share capital, stock prices, right? Therefore, market discipline is that you have to declare everything. Let the market decide whether you are good or bad. If you are bad, they will not invest. So your share prices will drop. If you are good, customers will invest. So your share prices will go up. So you are good. Right? That is the pillar 3. Pillar 1 looks at minimum capital adequacy, that is the Cook ratio, which I didn't tell you earlier. But last week I told you, Cook ratio, Peter Cook, right, was the first chairman of BCBS, Basel Committee on Banking Supervision, right? That committee introduced the Basel Capital Adequacy Ratio. He was the Vice Chancellor of Bank of England, right? So minimum capital adequacy, if I go back to the board, minimum capital adequacy equals capital divided by risk weighted asset, right? This asset is of two types: direct asset and indirect. On balance sheet, off balance sheet, right? Give me example for on balance sheet asset. Assets means facilities. We have discussed contingent liabilities and on balance sheet. Try again. No, we are talking about facilities. We are talking about LCs, we are talking about term loans, we are talking about credit cards, we are talking about guarantees, those kind of things. Out of them, what is the on balance sheet, direct facility and an indirect facility?
Direct facilities are loans.
Yes.
And indirect is LCs.
Guarantees and those
guarantee,
things.
yeah.
Yes. Wherever money goes out of the bank, as soon as the facility is granted, it is a direct facility, right? Where the bank take only a responsibility, it is a indirect facility, right? When you are working out the asset, you take all the indirect facility amounts, term loans, ODs, credit cards, etc., etc., right? But indirect facilities, you need to convert into direct facility, right? We say we have a LC of 100 million. You don't consider this 100 million, like we have a term loan 50 million. We take this one as 50. But LC, we don't consider entire 100, right? We have to multiply this by something called credit conversion factor, right? There are 3 credit conversion factors: CCF, 100%, 50%, and 20%, right? If this LC is a standby letter of credit, we have to multiply it by 100. If it is a trade-in letter of credit, this weight is 20. Instead of a LC, we have a bank guarantee. Then credit conversion factor is 50. Right? Like that, you have to convert all the indirect facilities into direct facilities when you are considering the asset value. Right? I have given you a handout. There it says all the direct and indirect, what type of credit conversion factors to be used for different indirect facilities. I have shared it, it is there. Today also I have loaded it. Right. Then you convert this. So minimum capital adequacy is this, right? Then so this one again we go capital divided by credit risk, operational risk, market risk, right? Under Basel II, credit risk was given 3 methods to take care of. Operation risk given another 3 methods, and market risk another 3 methods. In your handout, all these names were given, right? But brief example was given. However, Institute has not asked anything about this. So I'm not going to tell you and explain you in detail what these are. If you want, you can have a general idea. The methodologies to be used here is given in your handout, right? So we will be discussing the credit risk purely, and first one is basic method, right? I'll show you the handout. Right, this is the thing I explained just now. This the first one is standard method. You can see the board still. Standard method. Then you have internal rating based method, internal rating based fundamental or basic method, internal rating based advanced method, right? These are the 3 methods you can use, right? Please go to the handout. Yeah. This handout, you have this, right? We will be discussing on this handout, right? Under the standard method, It is a small deviation from the Basel 1. What happened under Basel 1? They gave us 4 risk categories. Based on those 4 risk categories, we had to wait, right? However, Basel 2, this initial method, what they did, they told, okay, you take a external rating, external risk rating for your customer. If Haley's won, they can take external rating. Based on the external rating, you decide a weight. What is external rating? It is a rating given by external credit rating agency like Moody. You know what they did to us last week. What do you mean by the rating? Rating gives us the credit worthiness of the customer, nothing else, just the credit worthiness, right? So Basel 2 first method, standard method, introduce external credit rating for our customers. So if my customer base is rated, based on these ratings, externally rated, not our own internal rating, externally rated, you can use those ratings to calculate the capital requirement. So I'll show you. This is an additional handout, is a detailed handout you can go through. Credit conversion factor, this example. This is the risk weights given, right? Look at the last line. If your customer is triple A to AA minus, risk ratings are this: triple A, BBB, and default, right? Triple A, double A, B, like that, you have different rating. These rates are called investment rate. Investment grade means suitable for long-term investment. These are speculative. Rates. That means it is risky but okay for very short-term investment, right? So risk ratings are ratings given by external agencies. Based on the risk rating, can you hear me? Can you hear me?
Yes, sir.
Right. Right? Based on the external ratings, they gave us weights. If it is somewhere here, it is 20%. Right? 50, like that. They gave different weights. Right? See, if it is triple A to AA minus, it is 20. A plus to A minus, it is 50. BB plus to BB minus 100. Then again 100. Then B plus to B minus, it is 150. Below B and default is 150, unrated 100. Unrated does not mean they're bad, right? That's why it is 100, and B and below it is 150. So it is a slight deviation from the Basel 1. In Basel 1, they gave 4 weights fixed, whereas this one, they allow the corporates to get evaluated by a third party and give a risk rating. Based on that, they gave the risk weight. So you could use RW from this risk weights, right? That is the first one. Then we will go to, right. Then we go to the other one. So we did this. This is based on external ratings, right? This is based on the external rating. Then we have internal rating based standard, basic and advanced. For this, what they use, expected loss equals PD, probability of default, into loss given default into exposure at default, right? This is the formula we use to calculate the capital, right? PD is probability of default. You have internal rating structure, right? We need to rate each and every customer of our portfolio internally. That also goes in line with the external rating, P and D. Triple A, P and D. Right? So based on the rating, we take the probability of default. Right? All these are calculated based on 5-year moving average. Right? We take AA clients based on our experience, what is the probability of default, right? Then loss given default, which is equal to 1 minus recovery rate, right? Loss given default is 1 minus recovery rate. This is calculated for different type of products, right? We say term loans, we say ODs, we say housing loans, like that. We say auto loans. Based on the past experience, if a auto loan goes bad, how much have we, what is the percentage we recover? If a OD goes bad, NPL, on average, how much we recover? So 1 minus that is loss given default. Like as example, if a OD goes, 60% we lose, only 40% we recover. If a term loan goes bad, 70% we recover, loss given is 30% there. These are based on our 5-year experience. So every quarter we calculate these rates based on 5-year rollover experience. It is for a product, right? So you calculate loss given default. Then exposure at default. That is, at the time of default, what was the exposure to this customer? Term loans, you take the outstanding balance. Short term, you will have to take the outstanding plus the wait for the unutilized. Checks may have come, guarantees may have given, right? You can't stop a guarantee, right? LC is open, so you can't stop a LC when the customer goes bad, right? Exposure at default is what is the exposure to a customer at the time of default, right? So we need to calculate what is the probability based on the risk weight. Probability a customer goes bad. Then loss given default based on the product. What is the loss if we consider? Then we have the exposure at default, right? These two are percentages. This is the absolute value, right? So under the IRB basic, bank is allowed to use our own figures for this. However, we need to get clearance from the regulator CBSL on these two, right? We have to calculate, show them and get the clearance, right? So that is IRB basic. Under advanced thing, CBSL, our regulator, will clear our methodology. Once they clear the methodology, we don't need to show them. We can take our own figures. The difference between basic and advanced is under basic, we can use our own figures without getting approval from CBSL, this figure. Other two, we need to get approval. But under advanced, you don't need to get that approval. You can straight away use your figures, right? That is the pillar 1. Pillar 1 is this. Pillar 3 is market discipline. Then we have pillar 2, which is internal capital ICAP. Internal capital adequacy assessment process, right? So what we do, we need to develop a process to calculate capital adequacy to cover up all other risks which are not covered under T1, which is credit, market and operation, right? Risk like legal, right? Then reputation, liquidity, trading book. Different risks are available, but we have not calculated the capital adequacy. So what they want us to calculate separate capital portion for this. Whatever the risk, we have not considered under P1, right? Then the supervisor, regulator need to go through our evaluation and approve. So it is regulatory review process, right? It is a regulatory review process. So this is the PGLGD. This bank computes only the probability of default. Bank compute all risk components, right? Then operation loss due to system. So this handout gives you everything: basic indicators, standardized approach, advanced measurement approach. You don't need to memorize these things. This is for your knowledge only, because we don't cover this under your syllabus. Market also, you have historical simulation, parametric, and Monte Carlo simulation. We have 3 types. This is the second pillar. Banks are advised to develop an internal capital adequacy assessment process and set targets to capital commensurate with the bank's risk profile. This element would provide a clear articulation of the bank's risk appetite by risk category and the quantification of any risk not included in pillar 1. Any risk which is not included under risk 1. Supervisor authority is responsible for evaluating how well banks are assessing their capital adequacy. So supervisor is required to evaluate our calculation. That's why it is called supervisor review process. Market discipline, I told you what it is. Then this is the Basel process. Implications are smaller banks and bigger banks will operate differently because these are system generated. Smaller bank does not have enough systems to generate this capital adequacy and risk management, so they will operate differently. So their capital calculation would be different. So with the same capital, if you have very good risk management, you can have a better book, a larger book. But smaller bank, without proper risk management, with the same capital amount, they will have to stay with a smaller book, right? So we don't know how the competition will be, right? And the third one is supervisor needs to rely on the bank's risk calculations. So it is a completely different from calculating into supervisory role, where they have to check the integrity of the calculations of the bank. So these are the difficulties in Basel. Firstly, larger banks will operate separately and smaller banks depend on the systems and processes they have. The second one, competition would be different because with good systems, they can use same capital and have a larger asset book. Thirdly, the banks will have to do our own calculation and supervisor need to supervise that calculation. They don't calculate per se. Right. That comes to the end of Basel. So you can have this lecture. Then you should take this one. Just go through it. It gives a lot of information, but the same things. Then what is this? Yeah, external credit ratings. I covered it. It is long lecture, but I covered the basics you want. These are the risk weights, right? So we have covered this, we have done this, we have done this, we have done this. So the last one, it is about credit administration, right? Any questions on Basel 1 and 2? Any questions on Basel? Under this one, the entire handout, what we say, no single transaction should be completed by people who are reporting to a single head, right? We should not have this one. You should have this, this, and this. If a transaction comes through, like we say, first one is the origination people, and approval and those stuff. So they should report to business head. Then you have risk department. They should report to risk head. Then you have operational unit who looks after the approval process. Credit administration unit, they should report to operational head. Right? So no single transaction should be completed by people who reports to a single head. Right? That is the theory behind it. So whoever brings the loan, approves the loan, there will be an independent party who looks at the loans. Then there has to be someone else who deals with the actual system, co-banking system, documentation. Those, they are called credit administration, right? All the offer letter preparations, system inputs, rate changes, security covenant monitoring, security perfection, everything has to be done by someone else, not by these people. So under credit administration discussion, it is here, right? So this is the first thing I showed you: initiation, originate the loan, evaluate, negotiate, approve. Then comes to the third one: documentation, closing, that means signing the documentation and getting the commitment. Then comes the covenant, condition, payment, compliance monitoring, all those things. Then payments accordingly, then it goes and repaid. If not, you have to work out early settlement strategies, reschedulements, and those things. That is remedial management, and go back and come back again, right? This is what the diagram I showed you, right? As per the BCBS, Basel Committee on Banking Supervision, what they say is the bank should have a system for ongoing administration of their various credit risk-bearing portfolios. That means we should have a separate system, separate people, separate unit, not reporting to the business head, to look at the different risk-rated portfolios. Like AAA customers, you don't need to visit biannually. You can just have a visit once a year. But if it is a customer or a B customer, you may be needing once a month visits and discussions and those things. That kind of a thing. Covenant monitoring, insurance register monitoring, all those things we need to do. So when you are developing the credit administration unit, These are the five factors you should ensure. Efficiency and effectiveness of credit administration. It has to be efficient and effective in doing their job. And accuracy and timeliness of information provided to MIS. Right? This is one 5 marks question. Efficiency and effective. Previously they have asked this. Efficiency and effectiveness, then accuracy and timeliness of the information provided. The third one, duties has to be segregated. One person should not do inputs and authorizations and everything, right? Third one, fourth one, control over the back office procedures, right? There has to be controls. One inputter and one authorizer always. Inputter goes input, then authorizer, the same person log in with another password, authorize. No. Inputter is inputter, authorizer has to be a separate one. Right? Right there. Then compliance with all prescribed risk management policies and laws and regulations of the country. Right? 5 points you need to consider when developing a credit administration: efficiency and effectiveness, accuracy and timeliness of information provided, segregation of duties, control over the back office procedures, and compliance to risk management policies and laws and regulations of the country. These are the 5 factors we need to consider. Then this is a list of items CAU perform: establishing and granting limits, executing, checking, maintaining security documents. We'll go to the detailed ones straight away. These are the functions CAU does, which the business line should not do. Establishing and granting of limits. Release, like once we do the approval, offer letter needs to be prepared by CAU and give it to us. Then we get it signed and give it to CAU. CAU will look at all the covenants, procedures we have put forward under the offer letter. Then they will create the limit in the system and do the disbursement. If we need to disperse stage, several phases, CAU has to monitor and do the disbursement. If we have given a structure in the offer letter, then CAU has to put the same structure into the system. Short-term revolving loans granting has to be handled by CAU. Second one, execution, checking and maintenance of security documents. Preparation, execution and maintenance of security documents should ensure completeness. Like all offer letters and security documents need to be done by these people. If there are different, like covenants has to be standardized, and if the covenants are different, they are the one who has to liaise with the business line and the legal department to get this covenant correctly. Right? Then all the document registration, like land registry, not the land registry, RMB, machinery mortgage registration, company registration, all those things normally needs to be done by CAU. However, property mortgages, land registration is done by legal department. Right? Release and replacement of collateral. You need to, once the facility is fully paid, you have to release. That's a function of CAU. Recovery of fees, upfront fees, monthly fees, all those fees is CAU's function. Maintenance of insurance and registry. insurance registry is the key item. If something goes bad, that is the way of transferring the risk. So insurance need to be perfectly up to date. So this registry need to be handled by central place CAU. Renewals, then exposure to different insurance companies, different sectors, those things need to be monitored by CAU, right? Providing no objection letters, putting claims, and everything has to be done by this unit, independent. Maintain collateral valuation. You know, every 4 years you need to take a valuation. So taking these valuation, continuation, updating share prices, currency fluctuation updates, stock inspection, like if you have taken mortgages or stocks, those stock inspection should be done by a third party, not by me. If I am the approver, I should not go, because then I will cover up myself. So I want third party to do that. So they have to do. Interest rate changes in the system, they have to do. Covenant monitoring is their issue. They will not their issue, they part of their job. Basically, it is the responsibility of CAU and the business line to monitor the covenants. Management reporting, they have all the data, so they are the ones who should provide new loans granted, new disbursement, risk-based things, and everything. Management information system, information providing has to be done by CAU, right? All other things are supporting documents. You don't need to go through this, right? Up to this point, you have all covered, right? This is the list. Once I saw a question, what are the functions performed by CAU? Then this was asked once, right? So this comes to the end of our entire session. So today we covered CAU and Basel 2. Okay, there's another one more thing, Basel 3. Right, Basel 3. Let me. Yeah, right. Go to this handout. We have Basel 3. Under Basel 3, yeah, these are the 2 points. Actually, under Basel 3, what they look at is to improve the quality of the share capital, right? Primary focus is to improve the quality, right? Then they introduce these two ratios, which is capital conservation buffers and counter cyclical buffer, right? That is to, in order to do two things, you need to allocate your capital separately. This is to control the bank. So they want us to create CCB, capital conservation buffer, which is 0.625 to 2.5% of the RWA, right? So you have to allocate your capital, but you can't use it to grant loans. In stress situations, yes, you can use it, but in that moment, you can't distribute dividends. You allocate your funds for this buffer, you can't use it, but we say there is a situation where capital adequacy ratio is breaching. Then you can use this to show the capital adequacy. However, if you use this to show the capital adequacy, you can't give out your profit to your shareholders. You have to stop that. So that is called capital conservation buffer. Then the counter-cyclical buffer, it is imposed time to time. When the central bank thinks there is an undue credit growth in the country, they can implement this. They can tell, okay, now we are activating counter-cyclic buffer. So you have to allocate your capital to that, which you can't use for capital calculation, right? Consisting of common equity with a range of 0.0% to 2.5% of RWA according to national circumstances. This addresses the excess credit growth that could result in a build-up of risk. High credit growth තියෙන වෙලාවට තමයි මේක පාවිච්චි කරන්නේ. Central bank comes and say, now you activate your counter-cyclic buffer across the banks, so your capital availability will come down. So you can't lend in order to control the market, right? So these are the main features of Basel 3. This is that. So we are good. These are the fun. If you have any questions, I can answer. We have time. I can answer you if you have any question. And I think we have a review session somewhere on 31st, I think, Saturday. If you have any questions, you can ask me. No, I have covered all the things. Please go through all the handouts I have given you, but don't expect cut paste answers, questions from handout. But what I have experienced for the last 11 lecture sessions I did, they ask questions from the handouts, but they term it differently. They want you to practically think and apply these, right? Take the basics and be practical in answering the questions. Right. So if you don't have any questions, I will stop the lecture here, and all the best for your exams. Hope to see you on review if you want. Right. Okay. Thank you very much.